Let's continue the conversation right here with Torsten Slok. He's chief economist at Apollo Global Management. You have a favorite in that Fed race, by the way?
Well, so I don't have a personal favorite, but I think it's clear that the market is trying to chew hard on which of these candidates will have implications for what's happening, especially, of course, in rates. What the conclusion, of course, here is that it all becomes about, can the new Fed chair persuade the other FOMC members about whatever his view might be. In this case, if the new Fed chair wants to cut interest rates, there are 12 voting members. The new Fed chair needs to come in and convince everyone else why it's a good idea to cut interest rates. As we know from the silent dissents, as we know from Jeff Schmidt from Kansas City Fed, it's going to be quite an uphill battle to convince, at least where we stand right now, the rest of the FOMC to cut rates in the current environment.
As it would be an uphill battle to convince you to cut rates too, Torsten, if you were on that committee. Why?
Because I think that the tailwinds that are building are becoming stronger and stronger here in 2026. Last year was a story of headwinds to the economy coming from trade war, immigration restrictions, and student loan payments restarting. This episode we're going into 2026 will have tailwinds from the one big beautiful bill. We'll also have tailwinds from the oil prices. We'll also have tailwinds from the dollar having gone down. So we're about to see a Nike swoosh where growth is going to accelerate. This is the consensus expectation. That's the Fed's expectation. That's our expectation. So that growth will get bigger and bigger as we go through this year. And as a result, when inflation is still already close to 3%, the risk to inflation still continue to be quite meaningful. So the bottom line is, I would be very reluctant with cutting interest rates in an environment where we have an economy that's beginning to accelerate, in particular because of the tailwind coming from the one big beautiful bill.
But what about the risk, sorry, Carl, of employment? I mean, we've been seeing numbers we have not seen in quite some time. I think we're at 4-year highs, at least. Isn't that a concern to you? And we haven't even started to talk about the impact of AI that may really come to the fore in 2026.
Well, one very important reason why job growth has slowed in the last 6 months is because immigration has slowed. The last several years, net immigration into the U.S. was around 3 million every year. The CBO is now forecasting that will be around 500,000 in the next 2 years. So in other words, we're seeing a fairly sharp slowdown. And as a result, the Dallas Fed has calculated that the new equilibrium rate for non-farm payrolls, which used to be 200,000 jobs created every month, is now down to 30,000 jobs every month. So a very important reason why job growth has slowed is indeed because immigration has slowed so much.
You did write this week that the Fed's biggest risk for next year is stagflation.
I still think that stagflation is the risk because there's still some headwinds coming, especially if AI does not deliver. There's a lot of things riding on AI continuing in 2026. The data center build-out, of course, has added a lot to GDP growth. And we have also seen when stock prices go up that consumer spending, especially for the upper end of the K, in the K-shaped outlook, continue to still be very strong. But if AI does not deliver on earnings, especially also if we begin to see a slowdown in CapEx spending on the data center front going forward into the next several years, that will indeed begin to raise some risks about downside to growth coming from the number one risk, namely AI rolling.
But it wouldn't take prices down with it?
No, because AI on its own is only about, if you think about data center construction, it's only about 4% of GDP. So that's why, given 60% of GDP is services, and we have now had the service sector inflation has been relatively stable. Yes, it's true that rents are pulling lower, but ISM services prices paid has really been going up. So there's a lot of different forces in inflation, and the data here that came out this week was somewhat confusing, to be honest. But the bottom line is, in the next 6 months, and especially when we get to April, we'll begin to see some fairly meaningful risk that inflation is still going to be elevated. And that's exactly why the FOMC members are so split on this issue. What should we do in an environment where, yes, maybe the labor market is a bit weaker because of labor demand, but given inflation is still very sticky and now is at risk of going up over the next 6 months, then the key issue for the FOMC becomes, can we even cut in that environment? That's why the only dot, of course, in the dot plot, the only cut we have is one cut here, of course, in 2026.